Welcome to The Explainer. Today, we are diving deep into a really popular but honestly a seriously misunderstood investment tool, the leveraged ETF. A lot of people see it as a kind of shortcut to making big returns. But the reality? Well, it's a whole lot trickier than that. So let me just start by posing a question that really gets to the core of this whole thing. What if getting 2 times the market's return every single day doesn't actually give you 2 times the market's return over, say, a month or a year? It sounds kind of like a riddle, I know, but it is the absolute key to understanding these products. And look, this is the basic belief, right? It's the entire sales pitch. You see that 2x label on the fund and you think, awesome, I'm doubling my exposure, I'm going to double my gains. On the surface, it seems completely straightforward. So first, let's just talk about that promise, the promise of 2x returns. The math we do in our heads is pretty simple. If the S&P 500 climbs 10%, my 2x ETF should be up 20%. It feels powerful, it feels logical. But as we're about to see, what happens in the real world can be shockingly different. Which brings us to our next section, a shocking performance gap. Because when we look at the actual data, this huge gap opens up between what we all expect to happen and what we actually get. We're going to use a perfect, and I mean perfect, case study. That super volatile period between 2007 and 2011. You know, the one that included the great financial crisis. Let's say you invested $10,000 and you used a classic margin account to get 2-to-1 leverage on the S&P 500. After those 5 crazy years, yeah, you would have lost some money. You'd be down about $780. Not great, obviously, but considering there was a massive market crash right in the middle of that period, it's kind of understandable. Now keep that number in your head, down $780. Okay, now let's see what happened if you put that same $10,000 into the popular 2x leveraged S&P 500 ETF. Its ticker is SSO. You'd expect a pretty similar result, wouldn't you? Well, you would be very, very wrong. You would have lost over $4,000. That's more than 5 times the loss of the traditional leverage. I mean, that is a stunning difference that should make anyone just stop and ask, wait, what is going on here? But hold on, it gets even weirder. And this is where it gets truly bizarre. The inverse ETF, ticker SDS, is built to make money when the market goes down. So during a period with huge market drops, this thing should have been a home run. But it wasn't. It lost even more, a whopping $5,800 on a $10,000 investment. Let that sink in. The product specifically designed to make money from a falling market lost over half its value during one of the biggest downturns in modern history. This just defies logic. So here's the final mind-bending test. What if you thought, you know what? I have no idea which way the market's going. I'll just buy $10,000 of the long ETF and $10,000 of the short one. Your total investment is $20K. One goes up, the other goes down. You should basically break even, right? Wrong. You would have lost almost $10,000. Out of a $20,000 investment, you're left with next to nothing. Buying both sides of the bet, what should be a totally neutral position, resulted in a near total wipeout. Something is fundamentally broken with how these products work over time. Now, the culprit behind all these bizarre results, it's not a conspiracy, it's a hidden cost, one that's generated by market volatility itself. So how is any of this possible? The key isn't whether the market ended up or down over those 5 years. The real problem is how it got there. All the jagged up and down, back and forth movement, that choppiness, that's the killer. This simple table shows you the core problem perfectly. If you start with $100 and gain 50%, you're at $150. Awesome. But then a 50% loss from that new, higher number takes you all the way down to $75. It's a fundamental rule of math. A big gain followed by an equal percentage loss always results in a net loss. And this destructive little math quirk has a name. It's called volatility drag. The best way to think about it is like a hidden tax on your portfolio. The more your investment bounces up and down, the more this drag just eats away at your long-term growth. It is a constant force working against you in any volatile asset. So, if volatility drag is the why, then how does it get so supercharged inside a leveraged ETF?
Well, the answer is in the fund's mechanics, specifically something called daily rebalancing. The trap works exactly like this. The fund gives you 2x the daily return, just like it says on the box. But here's the catch. At the end of every single trading day, it resets itself to maintain that perfect 2x leverage for the next day. This constant daily reset is the entire problem. It basically bakes that destructive volatility math right into the fund, compounding the drag day after day after day.
So here's the crucial thing to understand. In a market that just goes straight up or straight down with very few reversals, these ETFs can actually work great, even outperforming their 2x goal. But the second the market gets choppy, with up days followed by down days, that math turns violently against you. The ETF will consistently win less on the way up and lose more on the way down than you would ever expect. The more back and forth you get, the worse the damage becomes. So, what's the bottom line here for anyone who's thinking about using these products? What is the final actionable takeaway from all of this?
Well, if you really want leverage, there are much smarter ways to do it. As the source material points out, the most straightforward way is just using a standard margin account to buy more of a regular unleveraged ETF. More advanced folks might use things like futures or options. The key here is that all of these methods let you avoid that destructive daily rebalancing trap.
And that brings us to the final takeaway, which is a direct quote from the source material. Investors and longer-term traders should simply avoid buying leveraged ETFs. It's that simple. They promise you a simple 2x return, but what they actually deliver is the painful, hidden math of volatility drag. It's a powerful reminder to always look under the hood of any financial product you're thinking about buying. And it kind of makes you wonder, what other hidden traps are out there hiding in plain sight? Thanks for joining this explainer.